Hey guys, welcome back to another episode of the Finance Bible podcast.
We are your hosts, as always, Oscar and Zeke. Please note that nothing in this podcast should ever be considered as personal financial advice.
If personal financial advice is what you are after, then please reach out. We can connect you with the correct professionals to ensure you get the job done properly.
Enjoy the show.
Let's get into it. Today we thought we'd just talk about tips on getting a home loan. Oscar, do you want to jump straight in with the first point?
Very, very good topic, this one. We are doing it off a post that we put on our Asset Road Instagram on the 25th of May, if anyone does want to join in. But the first point is, and extremely vital, is working on your credit score. Because when it comes to getting money or being lended money, the bank's not going to give you any dosh if you're proven to not be able to pay back or miss repayments for your car loans, phone bills, all different types of bills. So one here to help you with your credit score is perhaps setting up automatic payments or reminders to avoid missing any payments, and consider paying more than the minimum required amount to demonstrate to the bank that you're responsible in terms of your financial behavior.
Another thing to mention on that is obviously you're taking care of all your pay later methods. So you Zip Pay, your Afterpay, even PayPal now has one where they pull credit checks. Commonwealth has one. So many different buy now, pay later things going on, and they really add up. Additionally, there's apps out there or websites out there like Credit Savvy where you can jump on there, get a free report every month. You can monitor what's going on. But this is kind of going to lead into another point that we're going to bring up, which is visiting a mortgage broker. So visiting a mortgage broker, they can pull a credit check for you, and it's like a soft inquiry, so it doesn't actually impact your credit rating. Whereas if you go to a bank and you go, right, I want to get a loan, I want to do this, I want to do that, they'll put your credit, put the inquiry on there, and then it's there. If you then go to another one because they're not going to give you the money or they're going to charge you a high interest rate or whatever it is, and you're shopping around, you go to the other bank, they pull a credit inquiry, bang, now you've got two within 2 days. You go to another one because you want to test out what interest rate you can get somewhere else, bang, 3 in 3 days. So within a 3 day period, if you're trying to borrow 500 grand, you've now requested $1.5 million in 3 days.
So don't go on for the sake of things trying to make inquiries to suss out the best deal, because it does affect your credit score. And that kind of comes back to credit cards as well. Credit cards are a big factor in this, especially in the younger, let's say, 18 to 30-year-old age group, because you realize you're eligible for a credit card and you might like all the points that comes with the sign-on bonus. And then all of a sudden you're $5,000 in debt, you've got no savings to pay it back, and you're paying the interest. And if you miss your repayments, obviously that's going to impact your credit score as well. So be smart with that. I know we're kind of getting on track of credit cards, which we'll get off in a moment. But credit cards, be careful, figure out before you actually apply for one if you can make the repayments, but that will impact your credit score if you don't pay those back on time.
Yeah, so make sure you've got a good credit score. We did a podcast separately on credit scores and how to manage them and different things that affect them. So I'd recommend listening to that, because this podcast is specifically focused on actually going for a home loan and different tips. Each tip will have their own individual things that need to be talked about. So we'll move on for now. Another thing to talk about, we already kind of mentioned it, was a broker space. Me personally, and Oscar, you can confirm or deny this, but I would not go to a bank directly if I was getting a loan.
Can confirm that strongly, actually.
Well, there you go. I've seen too many issues with it, like not getting the money or getting money at a high interest rate or willy-nilly pulling credit checks or having limited products and a whole bunch of different things. If you go to a mortgage broker, they can sit down with you. They can do the soft credit check, as I said. They can figure out what you can borrow, what you can't borrow, roughly what's safe and what's not safe, tell you your limits so you can play with safety parameters in your head and figure out the repayments and everything at different institutions, different financial lenders, and then you can make up your mind from there.
I think the best thing about a mortgage broker is, let's say you go to a direct bank for a loan. Let's just say Westpac, for example. We haven't experienced Westpac. This is just purely an example. They will only offer you what Westpac's best product is at the time. So it might be a relatively high interest rate compared to other competitors. But if you go to a mortgage broker, they will compare around 40 different lenders, for example. You got your Westpac, CBA, might have Liberty, Mortgage Market, all these different lenders, and filter through and figure out who is the cheapest, who offers the best rate, who can structure the loan the best way possible, and literally process of elimination and give you the best broker. And they will walk you through and actually show you the comparisons between the others. There's no bias because all brokers work in your best interest. There's no banks don't do any different commissions for etc. But they will give you the best lender in the whole pond.
Yeah, they're legally obliged to act in your best interest. They have to give you a written reason of why they're recommending that specific lender and what the benefits are, the risk reward, and compare them to other lenders, as we just said. Moving on to the next point, Don, throw one out there.
I would say saving for a down payment is probably definitely the most important one, because if you don't have the money, you can't really get a loan, can you?
That's valid.
So lenders typically require a down payment, as you imagine, as a percentage of the total home price. Generally, it fluctuates between 10 and 20%. Some are different depending on the lender, but let's say, in my mind, I would want to save at least 10% of the purchase price before I'd actually legitimately think about getting a loan.
Yeah, you do need to save up money. I mean, if you've already got a property and there's a bunch of different things going on, you've got equity, you're at a certain LVR, like loan to value ratio, and all these different things, you can kind of do it differently. Or if you're a first home buyer and you're putting down 5% and you've got that whole entitlement going on, then it can vary. But very basically, if you're going for a loan, you've got 10% of the deposit. What you've also got to then take into account is you've got fees. You're going to have LMI at a 10%, which is lender's mortgage insurance, basically an insurance. You can Google it. We've done an episode on that.
Don't need to
Um,
Google it. It's on the Asset Rate Instagram page. There is
there
a
you
whole
go.
what is LMI?
We'll actually drop the link for that specific post. Make it easy. And then you've also got to take into consideration like stamp duty. For example, that can come in at like 15 grand, 20 grand, 30 grand. So if you're saving up for a property and you've got a 10% deposit, that could very quickly turn into 5% or 4% due to stamp duty, depending on the actual price of the property, obviously.
And that leads back to having a professional team in your corner. Because if you went and did this yourself and you had no experience of what stamp duty is or the other the costs associated with purchasing property, you might be in for a rude shock. So if you have a professional who can at least let you know this is the rough expenses which will come through, this is how much you'll need in terms of cash, it will put you in a lot better place.
Yeah, a good conveyancer or a good solicitor can also help with that and help with the calculations behind it all, but your broker should do it, and or the bank if you're going bank direct. Again, it's my advice. This isn't financial advice. I would say the next point for me, and I think in today's market, this is probably more important than ever, getting pre-approved for a loan. In the current market, if you don't have a pre-approval, it's very difficult for you to actually get a sales contract on a property, because a lot of people have pre-approvals. As an agent, if you're selling a property, you've got someone with a pre-approval, you have someone without one, I'm pretty sure you know which one they're going to pick, regardless of the offer, because they want the stability, they want less work, they want to get the job done. So if you get a pre-approval, firstly, you know exactly what you can do, you're pre-approved, you're ready to go. It makes it quicker for you, quicker for the seller, everyone's happy. Common sense, get a pre-approval.
Yeah, and in terms of pre-approval, it doesn't mean that you're fully locked in before you want to be. It just literally shows, all right, well, if I did go for a loan, I can service this amount, so I can actually service it, which is great. And like you said, in terms of there's 3 buyers, the one with the pre-approval, it demonstrates to the seller that you are an actual serious buyer. So they're not going to take the other 2. They're going to take your offer because you're ready to go, which is a big no-brainer. And brokers as well don't charge for this. So if you're scared in the past of getting a pre-approval because you don't want to spend money on a mortgage broker, they don't charge anything for it. So it's perfectly fine to do. And it's probably a really vital step.
I will say most mortgage brokers won't charge. I've come across a few cowboys in my time who might put a little fee on there.
Now, next step, let's say you've got the deposit, you've got everything sorted, you've got the professional team in your corner, you've got the pre-approval. they've accepted your offer on the house, and then it's time working with your mortgage broker to get all your documents in place to actually get the loan moving and get it sorted. So we're talking pay slips, relevant IDs. If you got other loans statements, if you've got a home at the moment, get your home loan statements. There's a variety of different documents, as your mortgage broker would tell you, but that will actually get the whole game underway.
Yeah, if you've got another property, you need probably a rates notice to show the ownership breakdown and have your name on the title. Tax returns for individuals. If you own a business and you're self-employed, you need tax returns for the business. If it's within a self-managed fund, then you need returns for the self-managed fund. If you're self-employed and a self-managed fund, then you need your tax returns, the business tax returns, the SMSF tax returns, and it can get pretty messy. So having a broker to help with that is quite good. And you need an accountant, clearly, because that's a lot of work. Yeah, the quicker you get your documents together and making sure you've got all of that ready, it just makes the whole process a lot easier. If you don't have any of that, I've worked with clients that it literally took about 4 months for them to get even half the documents together. So yeah, get all of that together. And then when you're actually ready to move on a property, you can get it quicker, which also comes back to getting a pre-approval. If you've got all your docs, you get a pre-approval, you're ready to go.
I love it. Love it. And going back to the purchasing a house with savings, if you have a home at the moment and there's a fair bit of equity in the home and you don't have too much of savings, you can utilize the equity in that home for a down payment on another property. So if you're wanting to invest in property and you'd have some equity in your home, good news is you can.
Another point to mention, this isn't included in the actual post, but fixed versus variable. You've got to figure out, once you've done all the other things, are you going to take a fixed loan or a variable loan? Again, your broker should help with this. If you're going bank direct, then you're going bank direct. But with a fixed versus variable, you've got to figure out what suits your financial situation better. I can't really say too much about this on the podcast because obviously it's not financial advice. Although my personal opinion, again, pending a lot of different circumstances, like, COVID came and this has happened, that's happened, GFC, blah, blah, whatever it is. If you're going fixed, then you're basically betting against the bank, right? So the bank have chosen a fixed rate. They know they're going to make money on that based on what they're predicting to happen in the future. Otherwise, they wouldn't offer it. So if you're choosing a fixed loan, then you're kind of going, well, actually, I think that you've got this wrong and the rate's going to go up from here. So fixed would be a better option than the long-term variable. If you go to a casino, house always wins, right?
Well, it depends who you are.
That's true. And there is mitigating factors.
It's a good gamble. You might come away with a win. But no,
you're on roulette, you bet on birds.
99% of the time, the house does win.
I mean, I've had some lucky streaks in my time on Casino Wars. I've got a pretty good win-loss ratio on that. But yeah, with the lending scenario, like, you can come out on top if you get fixed. For example, the people who fixed it 1% or 2% during COVID, happy days. Like, you really outsmarted the bank there. Did we know what was going to happen? Absolutely not. So again, it's throwing money on black and hoping for the best. One final tip before we let you go, which isn't really related to actually getting the loan or anything.
Ooh.
We've done an episode on it before, the rainy day fund. If I'm going out and getting a home loan, I'm making sure I've got a rainy day fund. A safety barrier to make sure that if anything does go wrong, I can meet those repayments and look after it. If I'm injured for 6 months, if I get sick for 3 months, if I'm off work for whatever reason, if I lose my job, if something happens to one of my children or a family member and I'm stuck in a really bad situation, I want that rainy day fund. Speaking of which, it's quite drizzly here today, and I'm a big fan.
Really? Is it?
Yeah. All right. Well, let's end it here. Call it a day. We'll see you all soon.
Ciao.
Guys, as always, if you've liked the podcast, please give us a review, jump on that 5-star wagon, share it around with your mates, and just give it the big odd tick.